This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode are Sam Hutchings and Peter Greig, portfolio managers of the Hennessy Equity and Income Fund. Welcome to Viewpoints, gentlemen. Let's jump right in. Peter, most active market participants have felt the Fed has done a good job at telegraphing their next move, if nothing else. Do you see that continuing, and what do you expect from them over the next 6 to 12 months?
Well, yeah, the Fed has done a good job in telegraphing their very next move as they've come up meeting to meeting here. They generally have speakers that go out and do a pretty good job of illustrating what they're thinking at the moment there. They've done a poor job of telegraphing out for the next year or so what they're expecting there. Coming into 2021, for instance, the last meeting in 2021, they expected 3 rate hikes for 2022, 75 basis points. We ended up with 11 rate hikes, 425 basis points, equivalent to 17 quarter point rate hikes. So their long-term forecasting isn't very good, but for that very next meeting, they've been pretty good about that. So the second part, what do we think about for the remainder of the year? Right now, it's about a third probability, about almost 50% probability for the December meeting. It's hard to argue with those, just a lot of data to come out still.
Sam, value continues to lag growth by a wide margin. When will the pain for value investors end?
Yeah, that's a question we get quite a bit at the Hennessy Equity and Income Fund. And before I answer it, we think it's important to say that we typically don't love grouping the market between value and growth. You know, as Warren Buffett said, price is what you pay and value is what you get. And growth definitely is a component in the calculation of value. Now, all that being said, you're right. High price stocks definitely have outperformed the market over the last several years, and especially year to date, where 7 names have driven 74% of the return of the S&P 500. But I think this year-to-date return has actually masked the fact that value had a really good year in 2022. If you look at the Russell 1000 Value Index, it outperformed the growth index by about 20%. And I think the conditions that allowed that to occur are very much still in the market today. And those conditions are growth trading at a premium, as Peter just talked about, the rising rate environment, and the chances of a recession are still on the table. If you look at valuations today, the growth index is trading at 2.1 times the value of the value index. The last time we saw that was during the internet bubble. And oh, by the way, when the internet bubble cracked, value outperformed for 7 to 8 years from 2001 to 2008. And that valuation today it's 2 standard deviations away from its 23-year average. The last time we saw that was at the end of 2021 before growth re-rated into 2022. In terms of interest rates, I think one of the biggest anomalies we've seen this year is the fact that high PE stocks have done well in a rising rate environment. If you think about what a high PE stock is suggesting, it's suggesting that there's growth in earnings in the future. And with higher rates, that's going to be discounted more than a low PE stock, which has higher earnings today. And so I think the reason we've seen that might be around some of the euphoria with AI and AI stocks in the market. And again, that's similar to what we saw in the internet bubble. And then finally, while the risk of a recession may have been lowered, don't forget we just started raising rates in this country in March of last year. We raised rates as little as July, or as most recently as July. And those typically take 12 to 18 months to go through the economy. And so if we do get an earnings recession, that's typically when valuation matters more. So we think the conditions are in place for value to do well going forward, but clearly time will tell.
Peter, the fund has roughly a 30% exposure to the triple Bs. How have the risk-reward dynamics changed in this tranche over the past 12 months?
Yeah, good question, Jay. That 30% weighting is of the fixed income portion of the portfolio, which is roughly 30% of the portfolio. So about 10% overall is in triple B rated bonds. That's a function of 2 parts from our side. One is we have a higher allocation to corporate credit than the benchmark in itself. We're about 60% in corporate credit for the portfolio. I'm sorry, we're about 53% for corporate credit. And of the corporate credit, about 60% of that is triple Bs. That compares to an index, which is about 45% corporate credit and about 30% in triple Bs. So that leads us to an overweight there of triple Bs. The dynamics haven't changed that much this year, but coming into the year was a tremendous opportunity in credit spreads in general, and corporate credit outperforms over market cycles. So we came into the year with credit spreads wider. We believed it was a good opportunity. Corporates underperformed in 2022, and so we've seen credit spreads tightened, with the exception of a brief widening significantly in March with the SVB failure there. So they widened out briefly there, but they've since ratcheted all the way back in and moved even tighter. Triple Bs have been the best performing segment of the investment grade market this year.
Sam, would you mind walking viewers through the investment philosophy and process for the equity portion of the fund?
Yeah, we think our process at the Hennessy Equity and Income Fund is pretty unique. We look to exploit two market inefficiencies. The first is time. We try to think like business owners. We hold some of our names, we've held some names in the portfolio for over 20 years, and we're not trading them like pieces of paper. And the other is around risk. We believe the market is much less efficient at assessing risk than reward. And the math on that's pretty simple. If you lose 50% of your value on a stock, it's going to need to double to get back to where you were. And so every part of our process is focused on minimizing risk. We do that first and foremost by focusing on high return on invested capital companies. Return on invested capital is a measure of how efficient a company is with its assets. It's a measure of the return that they get from every dollar invested in it. And typically, companies with high returns on invested capital have some form of competitive advantage. Think of things like brand strength, scale, maybe patent protection. And we really consider ourselves more business analysts than stock analysts. We're doing deep dive fundamental work to make sure that competitive advantage is not only sustainable, but ideally incrementally improving through time. And if we get that right, the companies we're investing in typically have strong, sustainable cash flows, which leads to a healthy balance sheet. And this brings us to the next part of our investment philosophy, which is how we value companies. We call it balance sheet optimization. This is a two-step process. In the first step, we assume an optimal capital structure, where we assume these companies can take on some low-cost debt to retire high-cost equity. And what that does is it lowers the amount of shares outstanding for the companies, and it also lowers their cost of capital. And then the second step, we do a very simple DCF, assuming very conservative assumptions, but now we use that lower cost of capital and the lower shares outstanding, and we're looking for companies trading at big discounts to their intrinsic value. And then in terms of portfolio construction, we're a conviction manager. We only own 30 to 35 names. We start new positions at 3 to 5%. So if we do things correctly, we think we're going to find really high quality companies trading at meaningful discounts, and then we conviction weight them and own them for the long haul, letting them compound in value. And I think that's pretty unique in the market today.
So Peter, on the fixed income side, you have roughly 60 holdings. What is the security selection process on that part of the portfolio?
Yeah, good. 60 holdings. The index, the benchmark, the broad universe is about 6,000 holdings and about 13 trillion in value. So obviously we have to whittle that down quite a bit. The first things we have to do is make sure we're achieving our targeted duration on an overall level, the interest rate exposure of the portfolio. Today, we have an interest rate exposure similar to that of the benchmark at about 3.8 years on a duration basis. We also have to allocate across the curve to attain that duration in a similar measure to the benchmark and not be significantly exposed to one part of the curve as the other. So we need enough securities to achieve those objectives, and then to mix to the proper allocation, which we already discussed there, where we're about 60% in corporate credit relative to the treasury allocation there, which is smaller. So one of the first places to cut is we don't need 203 intermediate treasury securities. We can have our curve allocation. with a much smaller number, 15 or 16 places along the curve we can allocate to Treasury securities there. With the corporate universe, what we're doing is we're doing credit work to identify companies with improving or at least stable credit trends and make sure we like them on a fundamental credit basis there, first off. And then we do a lot of relative value work. So we don't only look for the company's industries relative to other industries and make sure that that industry is trading at a good relative value today, but then we look at that company within their industry to make sure that we like their positioning and that it's attractive on a relative basis, not only that their industry to all industries, but their company relative to their industries. And then we even go as far as to pick the individual securities. Bank of America might have 50 or 60 securities in a benchmark, and that's the largest corporate issuer out there. We have 1 or 2 positions in the name there. So much, much smaller. We have to drill down, but we have to make sure those positions are attractive relative to the curve, the credit curve for that name, that issuer out there. And you'll see bonds that trade above and below their individual credit curve. So that's kind of the third part of a relative value decision there. And through all those decisions, you can come up with a portfolio of 30 to 40 corporate securities that you can have allocation to a broad range and diversified across a number of industries, a number of sectors, and then identify the best companies and individual issues of that issuer.
A follow-up question, Peter, and let's go a little bit more higher level and philosophical. It's been really challenging for fixed income investors the last couple of years. Why is it still an important component of a diversified portfolio?
Yeah, it has been challenging. We saw the first 2 negative years in the history of the modern day bond market indices with 2021 and 22. And as a matter of fact, 22 was a magnitude of 4-fold the previous worst year for return. So we've seen a real significant bear market for bond investors, but that's created the opportunity there as well. So today we have yields that are the highest that we've seen for an investment grade bond portfolio. It's the highest we've seen in 15 to 17 years, depending on the benchmarks you're using. So now is a great opportunity for bonds to play that role in a diversified investment strategy. We have the yield to add a buffer there that will offset if there were to become a period where equities were to underperform. Your bond portfolio should perform very, very well. And we have a yield now that we haven't had in a long time that's going to give us a base sort of level of return. We think the next few years, the return from an investment grade bond portfolio like this is going to be very rewarding for investors.
Sam, let's wrap up with some of your individual holdings and just maybe you could give us an overview of what the investment case is for them. What is the investment case for Apple today?
Yeah, Warren Buffett just referred to Apple as one of the best businesses that he owns. And we've been lucky enough to own it in the fund since 2016. And over that time frame, they've more than doubled the installed base of devices in the market to over 2 billion, of which 1 billion of which are iPhones. And the real magic of this business is they're growing the services component, selling into that installed base. And services is much higher margin. It's often repeatable with subscriptions, or it happens more frequently than a device purchase like Apple Pay. And what this is leading to is the really strong, sticky free cash flow. This has made Apple a financial fortress on their balance sheet. They have 61 billion in net cash and investments, and they're returning that capital to shareholders. Over the last 5 years, they've repurchased 19% of shares outstanding, which is unheard of. In terms of valuation, it may be a little elevated in the near term, but we think as services continues to grow, that it will grow into that valuation. And they also have a ton of capital flexibility with how strong that balance sheet is. And so we're very much long-term believers in that business.
Sam, as a follow-up, they recently launched their new iPhone. Do you have any thoughts on how that could impact their revenues going forward?
Yeah, the upgrade cycle for iPhones is typically 5 to 7 years, depending on how old the phone is. There aren't a lot of really new whiz-bang features on it. But again, like we said, what's really important is growing that installed base. So if they can get more and more people to buy that phone, you'll see the high margin services revenue continue to grow going forward.
So Sam, what is the investment case for BlackRock?
Yeah, BlackRock is the 800-pound gorilla in our space. They have 9.4 trillion in assets under management, and that gives them really strong brand and scale advantages. They also own a third of the ETF market, and that has had some nice tailwinds behind it. What BlackRock has been really good at doing is what they call their whole portfolio approach. This is where they offer a broad spectrum of products to the clients. They offer everything from active to passive, equity to fixed income, and also alternatives. And what this has allowed them to do is to take share. In 2022, they captured 1/3 of all long-term flows in the industry. And over the last 5 years, they captured 1.8 trillion in long-term flows, which is about a 5% organic growth rate. And that compares to the rest of the industry at flat to negative. In terms of valuation, using our balance sheet optimization approach, we think this stock is trading at a mid-teens discount, and we would be buyers today.
And finally, what is the investment case today for Starbucks?
Yeah, Starbucks is a category leader in the specialty coffee space. They have about 40% market share in the US and leading global share in the markets that they play in. This is a great category to be invested in. It's typically grown at 5 to 6%. It's highly addictive, which leads to strong pricing power of 1 to 2%. In the United States, they have 31 million loyalty members. These loyalty members spend at 2 to 3x the rate of non-loyalty members. And they're now making up more than 50% of sales, leading to sustainable cash flows. And Starbucks is taking that cash flow and they're investing back in the business. They have some of the best unit economics in all the consumer discretionary space. A new store has a 12 to 18 month payback period, and they get cash returns on that of over 50 to 70%, depending on the geography. While we think investors should look at it today, because the China business is not back to where it was pre-2019. We think there's strong tailwinds to global coffee consumption, and it's trading at a discount to its 5-year average PE and EV/EBITDA, which historically has been a good time to buy it. So we are very much buyers of Starbucks today.
Excellent. Gentlemen, thanks for spending some time on Viewpoints by Hennessy. Viewers, to learn more about the whole suite of Hennessy funds, visit hennessyfunds.com.